Hello and welcome. Today we're looking into the world of investing, which can seem, well, pretty complicated sometimes.
Yeah, but it maybe doesn't have to be. We've been looking at a really interesting conversation with Moshe. He's an investor, blogger, author.
Right, and we're going to pull out the key ideas from that discussion.
Exactly. The goal here is to help you figure out how to build wealth, effectively, without getting totally overwhelmed by all the jargon and noise out there.
We're talking real strategies, common mistakes people make, and the psychology behind it all, which is often overlooked.
Definitely.
So if you've ever thought, investing, that's too complex for me, or it's too risky, or maybe I'm just not good at math,
Uh-huh.
then stick around. I think you might have a few aha moments today. We're going to unpack why going for boring might actually be the most exciting way to reach financial freedom.
It sounds backwards, but yeah.
Okay, let's jump in. Mato says something pretty bold right away.
Yeah, like really counterintuitive
He actually wishes people would lose money.
in their first year of investing. Which sounds crazy, right? Why would he say that?
I know. But his reasoning is fascinating.
It really is. He's not talking about the money itself, not really. It's about the learning experience.
Learning? How so?
Well, that first loss, it teaches you about yourself. Your own temperament, how you actually react when things go down, your real tolerance for risk.
Ah, okay. So it's self-discovery, not just numbers on a screen.
Exactly. It highlights just how much investing is about, well, psychology, rather than just knowing all the market stuff.
That's a big point he makes. The real problem isn't the complexity. You don't need some fancy finance degree.
Not at all.
The challenge is, well, it's in our own heads, isn't it?
Yeah. Trusting that the economy will grow over the long haul. And resisting that urge, that constant nagging feeling to check your investments all the time.
Especially when the market gets choppy.
Oh, absolutely. His advice, start small, maybe just a little bit, like he says, even 1,000 PLN. See how it feels. And then maybe step away from the news for a bit. Cut off the information overload.
Right, stop checking it every 5 minutes.
You got it, because that's often our biggest hurdle. Resisting the daily checks, not hitting the panic button when some global event or, political comment makes the market wobble.
And he mentioned a common mistake, especially, he noted, in Poland, but I think it's everywhere.
Oh yeah, the waiting game.
Waiting for the perfect moment or waiting until you have more money.
Right. And all that waiting just means lost time. And time is, well, it's everything with compounding.
So true. And then there's greed. People focusing too much on, like, beating their neighbor or hitting some crazy high return, say 15% instead of a solid 12%.
Yeah, instead of just understanding that time in the market is what really builds wealth, not timing it perfectly or chasing those extra few points.
And that idea about needing to be a math whiz.
Totally false, he says. Sometimes, maybe people who are math geniuses do better because they just stick to simple, proven methods.
They don't overthink it.
Exactly. They just let it ride. No constant tinkering.
That ties into trying to beat the market, doesn't it? So many people try.
They do. But the numbers, even looking at aggregated tax data on stock trades, they show it's incredibly hard.
Really?
Yeah. Only about half of individual investors actually make a profit. And often, it's pretty small profits, while the losses can be quite large. Even the pros, the fund managers, struggle to beat the market consistently.
Wow. So our ego, wanting to be the genius picker, that could actually be hurting our results.
It absolutely can. Making overly risky bets, thinking you're smarter than the average, these psychological traps can really wreck your investment performance.
Okay, so if ego is a problem, what's another big one? Mateus talks about being a cost killer.
Ah, yes. Costs.
Yeah.
Fees. He really hammers this point home. The impact of fees over the long term is just vast.
That 2% example.
Exactly. A 2% annual fee sounds small, right? But over, say, 30 years, it can wipe out nearly half your potential final capital.
Half. That's staggering.
It is. It's the silent killer of returns. Those little percentages just compound against you year after year.
He had a good analogy for that, didn't he? Something about hairdressers.
Yeah. You'd pay a professional for a good haircut, sure. But you wouldn't pay, like, 5 times the price for the same simple trim if an equally good, cheaper option exists right next door.
Right. So why do we do that with finance?
Good question. His point is, yeah, trust professionals, but look for value. Find those who offer good services at a much lower cost, maybe 0.1% instead of 1% or 2%.
And how do they do that?
Often by cutting out the huge marketing budgets of those big sales networks. They focus on the service, not the flashy ads.
Okay, so our psychology can trip us up, high costs can eat away our money. So what's the practical solution he points towards if boring is better?
This is where he brings in ETFs,
That's right.
exchange-traded funds, and also index funds more broadly.
Right. So accessing those cheaper professional strategies, what are ETFs exactly? They trade like stocks, right?
Yeah, they trade on stock exchanges, so they're easy to buy and sell. That's the high liquidity part. And the key is they usually have very low
Like a
costs
low cost.
because most of them are passive. They aren't trying to pick winners or beat the market. They simply track a broad market index, like the S&P 500 or a global index. Less management, less cost.
Got it. So an ETF isn't just one company, it's like a whole basket of them.
A huge basket, often. Maybe 1,500 companies, sometimes more. Big ones, smaller ones, companies from all over the world, not just the US or, Poland.
So you're betting on what? Global growth.
Pretty much, like Matthias says, you're kind of just crossing your fingers for the world economy to keep growing over time, betting on overall human progress and innovation.
And the ETF sort of automatically adjusts.
Yeah, that's the beauty of index tracking. The successful companies grow bigger, so they become a larger part of the index in the ETF. The ones that fail eventually drop out. It adapts automatically.
Which leads us straight to diversification, doesn't it? The old don't put all your eggs in one basket saying.
Exactly. And Matthias has a great line on this. Eggs will break all the time in investing. You can't avoid all losses.
So the goal isn't to never lose, but to spread the risk.
Right. So if one egg breaks one company or sector has a bad run, it doesn't smash your whole portfolio.
This really pushes back against those genius ideas like going all in on one hot sector, say AI right now.
Definitely. Because what if AI isn't the only winner? Or what if the specific AI company you pick isn't the one that ultimately succeeds? A broad, diversified ETF will capture the winners wherever they emerge. It benefits as AI gets implemented across all industries, not just in the tech sector.
Okay, diversification makes sense. Low cost makes sense. But you mentioned liquidity. Easy buying and selling could be a downside.
No, that sounds great, right? Easy access. But Mateos points out it's a bit of a double-edged sword
Okay. Why?
because it makes it too easy to panic.
Ah.
When markets dip, like he saw happen dramatically around March, April 2025 with newer investors, that sell button is just one click away.
So people sell at the bottom out of fear.
Exactly. They turn those paper losses, the virtual red numbers on the screen, into real permanent losses, all because it was so easy to react emotionally.
Even if they were investing for, say, 30 years.
Yeah, they forget their long-term plan and react to short-term noise.
Hmm.
He notes it gets much harder psychologically when you're looking at bigger drops, like 40 or 50% down. Buying more then feels really scary, even if it's the logical long-term move.
Which reinforces his point about investing ideally being, well, boring.
Yes, it feels exciting, like a casino, you might be on the wrong track.
The real wealth comes from consistency.
Consistency and time. That historical average return, maybe 7–8% a year, or 4–5% above inflation for a diversified portfolio, that doesn't sound thrilling, but over 15, 20, 30 years, that's where the magic of compounding happens. It's not about hitting home runs.
He mentions that story, I think, from Morgan House's book about the unassuming guy.
Oh, the janitor or attendant who quietly amassed millions. Just by consistently investing small amounts over decades in boring blue-chip stocks or funds. Nobody knew he was wealthy.
Because he wasn't flashy, he just did the work.
Right. When investing becomes boring, Mateus argues, that's actually a sign of maturity. It leads to better results because you're not chasing excitement or falling for hype. That euphoria from quick wins, that's dangerous territory, more like gambling.
Okay, that's a powerful mindset shift. Now, Mateus lives in Poland, and you hear a lot there about real estate being the go-to investment. Buy apartments.
Yeah, it's a very common view, seen as safe, passive income.
But he pushes back on that.
He really does. His argument, real estate is far from passive.
How so?
Think about it. Getting loans, dealing with renovations, finding and managing tenants, maybe dealing with property management companies, it takes a ton of time and energy.
True, it's almost like running a small business.
Exactly. And then there are other risks he points out, like demographic shifts in an area or just the lack of diversification.
Lack of diversification, how?
Well, if you own, say, 7 apartments, but they're all in Warsaw, your entire investment is tied to the fate of one city's economy and property market. That's concentration risk, not diversification.
Good point. Okay, shifting gears slightly. Financial independence, early retirement, FIRE. Mateus is aiming for that.
Yeah, he mentions being about 80% of the way there at 36, which is amazing. But he adds a really important warning.
Which is?
You have to be mentally prepared to go back to work if things go wrong. Your capital might not last forever due to unforeseen circumstances, a market crash, unexpected expenses, whatever.
So FIRE isn't necessarily forever.
It might be, but you need a plan B. He also talks about the famous 4% rule for withdrawals.
Right, taking out 4% of your portfolio each year.
Yeah, but he suggests maybe being more conservative, especially if you retire early and have a longer time horizon, like 40 plus years. Maybe aim for 3% or
Or
3.5%.
factor in state pensions too, like ZUS in Poland or Social Security elsewhere.
Absolutely. That reduces the total amount you need to save yourself. But you need to actually do the math.
Yeah.
Figure out your annual expenses, divide by your withdrawal rate, say 40.03, and see what number you get.
It's often a shockingly big number, right? Millions.
It can be, yeah. It's a reality check. He also suggests maybe take a sabbatical first, like 6 or 12 months, before committing to FIRE. See if you actually like having all that free time and figure out what you do.
That's smart. And speaking of needing capital, he had some great advice on actually earning more money too from your job.
Oh, yeah, that was fascinating. He wasn't passive about his career. He actively pushed for raises.
Wow.
He bothered his bosses, as he put it. But crucially, he used data. He mentioned finding salary data, even referencing a Swedish thing like a public phone book listing salaries to benchmark and negotiate.
Wow, using data for salary negotiation.
Yeah. And learning to manage his responsibilities, not just taking on more and more work without fair compensation, and being willing to switch jobs for better pay and opportunities.
It really underscores that your earning power, your main job, is often the biggest engine for building wealth in the first place.
For most people, absolutely. Investing is crucial, but you need the fuel, the income, to make it work.
Okay, let's talk portfolio structure. Materas isn't a fan of those simple rules of thumb, is he? Like the 100 minus your age rule for stocks versus bonds?
No, he really challenges that. The idea that you just subtract your age from 100 and put that percentage in stocks, he says it's way too simplistic.
Why? What does it miss?
It ignores the individual.
Yeah.
His example is great. Two 36-year-olds.
Okay.
One has 3 young kids, earns a decent but not huge income, has maybe $500,000 saved. The other, no kids, high-flying corporate job, maybe $1.5 million saved.
Right. Very different situations.
Exactly. Should they really have the same asset allocation, like 64% stocks and 36% bonds, just because they're the same age?
Probably not. Their goals, their ability to handle risk, their need for stability are totally different.
Precisely. The parent might need more bonds to lock in funds for the kid's education or a house down payment. The high earner might be comfortable with almost all stocks, knowing they can easily save more if there's a downturn.
So your portfolio needs to match your life, your goals, not just your birth year.
That's the core idea. Goals-based allocation, driven by your personal circumstances.
Which kind of brings us full circle to the psychology. Staying calm, sticking to the plan. Mateus seems pretty unfazed by all the global turmoil.
Yeah, he mentioned that despite everything happening since 2022, wars, instability, economic worries, he basically changed almost nothing in his core investment strategy.
Just kept investing.
Pretty much.
Yeah.
Because his strategy is built for the long term and is globally diversified. It's designed to weather storms.
It's easy to get caught up in the negativity, isn't it? Feel like these are uniquely terrible times.
Oh, absolutely. Fatalism, he calls it. The constant news cycle, social media, it amplifies everything and makes you feel like the sky is always falling.
But if you have that long horizon and diversification,
You can feel more secure. You understand that markets go through cycles, that bad news is constant. But overall, the trend has historically been upwards. It helps you ignore the noise.
that's a really valuable perspective. Wow, we've covered a lot.
We really have.
From why simple and boring is often best, the huge role of psychology, killing costs, embracing ETFs and diversification.
You're questioning real estate's passivity, thinking critically about FIRE, boosting your income, and tailoring your portfolio to your life, not some formula.
Mateus Samoic's insights are really practical, and folks can find more from him at investomat.eu. It really feels like this approach makes building wealth accessible to anyone willing to be disciplined.
I agree. And the books he recommends, like Bogle's Little Book of Common Sense Investing, Household Psychology of Money, Muvi's Just Keep Buying, they all echo these core ideas. Simple, long-term, low-cost passive investing. It's about empowering yourself.
So maybe the final thought for everyone listening is, what's one step you can take this week to make your financial future a bit more secure and maybe just a little more boring?
Thank you for your attention. We encourage you to subscribe to our show for more insightful discussions.
See you next time.